also have Alastair Newton joining us right now on the show to talk a bit more about this geopolitical tension, the kind of repercussions it's likely to have on the equity markets and on the investor mood overall. Alastair, thank you so much for touching base. Gold is near a six-year high. Geopolitical tensions are stoking oil in a very, very big way. Brent is past $70 a barrel. Equity markets, of course, are massively spooked. How do you read into these geopolitical tensions, and do you see sustained tension and sustained volatility across the board?
The short answer to your final question is yes and yes. I think we are in for a phase of probably very sustained volatility, maybe even through all the way to 3 November and, from Donald Trump's perspective, the all-important US election. Now, having said that, I do think we need to keep oil markets, at least, firmly in proportion. If we think about what we have seen since Friday morning, when the news of General Soleimani's assassination first broke, it's actually been what I would describe as a measured reaction by the investment community. We saw a hike of roughly 3.5% in the price of Brent crude on Friday, compounded today by, as you rightly report, the rhetoric which has been going on over the weekend, in particular, Iran's statement that it will no longer feel bound by its commitments under the 2015 nuclear agreement. Now, so far, it has done nothing further to break away from those commitments, and we only have words, not actions. And that probably accounts for why we've only seen Brent only rising by a further 2% this morning. So overall, we're still seeing a total rise, which is much more modest than the one we saw after the strikes against Saudi Aramco back in mid-September, which, of course, were a direct attack on oil supply, which we haven't seen to date. So I think the investment community at large is still looking at what largely amounts to a tail risk as far as oil supply is concerned. And of course, as I don't have to tell you, markets are not necessarily that good at pricing in tail risks. Main concern for markets today, lots of uncertainty. And the ball being very much in Iran's court, the question is, what is Iran going to do next? And quite simply, we don't know the answer to that in terms of concrete actions as opposed to rhetoric and threats, which is what we've seen largely over the weekend. And it may be that whatever Iran decides to do next does not pose a direct threat to oil supply. And I think investors at the moment have got that pretty much in mind by the very modest rise in oil prices, which we've seen.
Okay, so all right, so you don't believe that whatever Iran does at this point of time is going to really have a serious impact on oil supply. That's interesting.
No, but sorry, I'm not saying that. I'm not saying that.
Okay.
What I'm saying is we simply don't know.
Okay, all right.
We have uncertainty. They could, personally, if you want my honest view, and I could be proved to be wrong even before you come off air today, I think Iran will bide its time over oil and look for other ways to hit back at the US. For example, increasing pressure on the Iraqi government to order US troops out of Iraq, Donald Trump's threats against Iraq notwithstanding.
Okay, all right. Well, calls are, I think, already been made, that U.S. should withdraw from Iraq. But Mr. Newton, this is not the first
non-binding.
Non-binding. But, Mr. Newton, this is not the first time that U.S. and Iran have obviously come at loggerheads. It's happened in the past as well. But this time around, we are actually seeing violence, right? Especially in Baghdad. So how... while, yes, I know you said that we'll have to wait and watch how Iran responds, but there have been certain responses. I mean, there were those bombings as well at the U.S. Embassy in Baghdad. So how real is it that these threats will actually be carried out, however verbal they are at this point?
Well, the risk is that one side or the other, i.e. Washington or Tehran, will miscalculate in some way. If we look at this for a moment from Tehran's perspective, it got away with a lot last year. Attacks on tankers in the Strait of Hormuz, the strike against Saudi Aramco. US reaction, very, very tepid indeed, to quote the New York Times article from last week, before all this blew up in the Gulf region in the last few days. Let's keep in mind that this time last week, we were anticipating that the biggest single factors driving the oil price this year were likely to be whether the OPEC Plus deal from early December would hold and what was going to happen over US shale output, which is in some doubt as to whether the increases we saw last year could be sustained. Now we have a clear prospective potential geopolitical threat to oil supply emerging in the Gulf. And it could be, sitting here today, I'm going to say to you that especially with the China-US trade deal likely to be ratified on the 15th of January, it could be that having had investment community focused very largely on US-China for the last 2 years or so, the main geopolitical driver of volatility in markets for the foreseeable future at least is going to be Gulf tensions and the price of oil. Hence, of course, the enormous impact on equity markets, which you have rightly been focusing on since Friday and again this morning.
Mr. Newton, I'm glad you raised that point. At this point of time, what it looks like is, or especially in the last 1 year, it's only supply disruptions that's actually hurting crude prices, or rather causing crude prices, to flirt with that $70 per barrel mark. Today as well, it's, I think, roughly at a 4-month high. But we are not seeing any concrete pickup in demand. Yes, you mentioned that the US-China deal may be ratified, hopefully, on the 15th of Jan. But do you believe that even, let's say, this tiff escalates and supply may be disrupted, in Iran and Iraq, still, how would you look at the crude markets in terms of a supply-demand point of view?
I think at the moment, supply certainly, all the data tell us that we've got an oversupply in the market at this time. If, and it's always a big if with OPEC Plus, if the OPEC Plus deal from 5 December actually holds, then that will help to moderate the supply side in any case. But overall, the general consensus among oil experts is we are likely to have an oversupply for at least the first half of this year. And I think that's likely to be proved to be largely right, unless we see some severe geopolitics-related disruption to supply. And let's be absolutely clear, we are only wondering about the increased risk around that today. There is nothing concrete out there today to suggest that there is actually a hard and fast increased risk to oil supply where things stand today. We could be revising that view within the next 24 hours, given the degree of uncertainty around the situation in the Middle East today. But right now, I think that the investment community has largely got this right with a 5% or so, 5 percentage point or so risk premium on the price of oil relative to where we were this time last week. As far as equity markets are concerned, I think we've all been in agreement for a long time that equities are, in some parts of the world at least, at an unusually high level, historically high levels, and that there may be a bubble there. What we're seeing, I think, is a certain propensity towards risk off, underlined by the increase in the gold price, obviously more gold purchases going on there. And that means that equities are going to struggle for a while, and perhaps particularly, to come back to your own market, in India, where, of course, higher oil prices are a sensitive issue as far as the economy as a whole is concerned.
Ms. Newton, great chatting with you. Thank you so much for taking time out and sharing with us
Pleasure.
your perspective.